Good morning and welcome to What's Up Monday. This is Dominic Chiricheller of the Energy Management Institute. It's March 19th, Monday morning, as we embark on another, what's looking already like a volatile trading week. I hope you enjoy our assessment. And if you have any questions, please feel free to email me at dchiricheller@emi.org or visit our website and you'll find contact information there also. And I'd love to hear from you and answer any questions you may have. So with that, let's move into the main parts of the presentation. There are just so many market moving events that we've seen over the last couple of weeks and we're likely to see going forward. There's all kinds of things coming in and around Washington, D.C. from a political perspective. There's a potential meeting with the North Koreans. There's a massive amount of economic data. There's talk of tariffs and the implications that could have on steel, aluminum, maybe broader commodities. And all of these are creating a cloud of uncertainty. And it's certainly moving most traders, whether it be in commodities, oil, financials, be it equities, currency markets, bringing their view to a much shorter time frame. I would venture to say there's a lot more people trading with a time horizon of 1, 2, 3 days, or really from one tweet to the next tweet from the president, or basically from one piece of economic data to another piece of economic data. But with that, let's look at today, knowing that that's in the backdrop. And the important thing to remember is that any of these things could derail what might be something good fundamentally, what might be something good technically. So we need to be cognizant of our surroundings and watch for all of those unforeseen events that could change a strategy on a dime right now. The market is nervous. When a market is nervous, it reacts quickly. Whether the reaction is right, wrong, or indifferent, the market reacts quickly. So we need to be aware of that. And I guess the safest way to trade in the environment we're in is to use trailing stops for whatever positions we take. So I would strongly recommend that from a trading perspective. And from a hedging perspective, I would say, look for your windows, look for entry points if you're on the buy side on the oil market, and don't worry too much about the hour-to-hour noise or even the day-to-day noise, because really from a hedging perspective, we're looking at more and more of a trend. So with that, we're going to talk a bit about the price direction and the snapshot and look at some of the key spreads here today. And obviously, we're going to talk about the dollar, the financials, or what I like to call the externals, the short-term fundamentals. We've had several pieces of data hit the market last week. I'll talk a little bit about that. We have obviously our weekly inventory snapshot coming up on Wednesday for the EIA, Tuesday night for the API. We'll talk a little bit about OPEC. Not really too much new there, but we'll talk about that. We'll mention the short-term temperature forecast and if it has any implications on heating oil demand, probably slightly more on natural gas, even though we're not talking about natural gas much in this presentation. And then we'll talk about quickly about some of the economic events and one big one in particular hitting us in the middle of the week. So let's look at where we are as of a little after 7 a.m. Eastern time this morning. The oil market is starting lower after having a strong Friday, but that strong Friday was really needed for the market to end the week in positive territory for the week, for the second gain in a week. The weekly gain wasn't all that much, but it certainly was a gain after all. But now we're starting a little bit on the low side here today. And I think part of that is being driven already by another sell-off starting to get started here in the equity market. Equities have been selling off since they opened up in Asia last night, and with futures markets in the United States on the downtrend and picking up. I mean, we in the United States, the equity markets declined 5 days in a row last week. So it was not a pretty picture for equities. It certainly those financials, those externals were really putting pressure on oil and really kept it capped last week. The dollar has been kind of up and down. We're a little bit lower this morning. We ended the week with a weekly gain in the US dollar index, not a big one, and with the euro and the yen versus the dollar, a little bit on a mixed picture basis. Currencies kind of neutral to slightly negative also for oil last week. So far this morning, I would categorize it as more on a neutral side. If we look at a little bit of a broader snapshots compared to the year to date, as obviously we can see we're running below the year to date. We're still above the forward curve, so the market is still in a bit of a backwardation, and not as much as it was a couple of weeks ago, but we're still maintaining that view, and that unto itself gives us a little bit of a feel that the market is still saying there's more positives than negatives for the medium term for oil, and we'll see how that forward curve evolves here over the next coming weeks. We're obviously still well above last year's average for the year, and again, that's a positive and a takeaway that yes, the market has gone through some headwinds, but it's still somewhat firm overall and still positive, and we'll talk about the reasons why as we evolve through that part of this presentation. Crack spreads are still kind of about around, with the exception of the ultra low sulfur diesel, so the heat crack here, which is a little bit positive compared to the year to date. The gasoline is about at the year to date one, but more importantly than that, the cracks are in a bit of a backwardation, and they're a little bit below where they were last year. So even with the fact that we're heading into this heart of the spring refinery maintenance season, we have not seen any kind of an uptick reflection in the crack spreads as of yet. And natural gas remains within a wide trading range of about 260 to 280. We got a little bit of cold weather as we finish up spring, finish up winter. I mean, we enter into the spring season here tomorrow, but some colder than normal temperatures evolving here. So if we look at the crude oil, let's look at the May WTI contract, May Brent contract. Although the April contract for WTI is still trading, it goes off the board tomorrow. So we're not going to really spend any time on it. And in reality, the April contract, May contract, both contracts trading very much in sync. I think the big takeaway that we see here is the sideways trading activity in both Brent and WTI. I categorize the market in a bit of a consolidation, ranging, choppy type market with not a lot of conviction. We're getting kind of mixed pictures from week to week on the fundamental side, and we got this tremendous volatility that's evolving from the external markets, both the equity markets, equity market in particular, and to a lesser extent from the financial markets. From a technical perspective, we're seeing the MACD slightly positive, slightly pushing to the upside. We're seeing the RSI and the directional movement index somewhat neutral right now. So the market's not overbought like it was several weeks ago, a month ago. It's certainly not oversold, so it's kind of looking for direction. And I think that's one of the reasons we're seeing this sideways trading pattern that we've embarked on here since the middle of February. On the spread side, the May Brent WTI spread, that's not spot spread right now, spot Brent WTI spread we're trading. Slight downward trend We're certainly not anywhere back here where we were at around $6 at the end of last year, $5 to start this year, 550, 560 premium of Brent WTI to start this year. But we're still at a level that makes the movement of crude oil out of the United States. There's still some economics. Short term, we've seen the spread recovering off of its lows. We did drop down to about 3. And over the last week and a half, 2 weeks, we see that we've been in a little bit of an uptrend with some sideways movement over the last 3 or 4 days. The Brent WTI Houston spread, kind of a similar thing. We've seen a little bit of a recovery here, but in a longer term narrowing of the spread. And again, the economics still support crude oil exports from the United States. Not nearly as economical as it was 3, 4 months ago, but still there's some positives to take away, and there's some positive reasons to export crude out of the U.S. The Brent WTI spread, just to kind of give you a little feel as to where it is within the 5-year envelope. The red line is the 5-year average. I like to use the 5-year max, 5-year min, rather than plus or minus 1 standard deviation. And again, you could see it's kind of recovered a little bit, but we're closer to the minimum, 5-year minimum than the 5-year maximum, and kind of between the minimum and the 5-year average. So over time, with exports of crude oil from the United States, we're kind of probably going to see this spread, not widening out strongly, unless, of course, we see a big cutback in international crudes going forward. On the product side, much like crude, we've seen a little bit of a consolidation, but the products have been a little bit more in a clearly defined downtrend, both for ultra low sulfur diesel and gasoline, kind of over the medium term. But again, we're starting to see a bit of a recovery here over the last week or 2 weeks. And both of these contracts are kind of near their linear regression channel resistance area. The technicals are a little bit more pronounced, a little bit more positive for products than crude, and that's explainable and understandable from the perspective of we're heading into the refinery maintenance season. So we can expect to see or continue to see a surplus of crude, a deficit of product as refinery runs remain below the 90% threshold and continue to move lower. So a little more positives on the refined product side, less so on the crude oil side, but from a seasonality point of view, this is very normal is what we're seeing right now. And as long as the decline in product inventories or the decline in product production exceeds the builds that we are expecting in crude oil because of the refinery maintenance season, we should still expect to see the total combined stocks of crude oil and refined products still working their way towards the 5-year average.